Welcome back to Market Brief After Hours. It is Tuesday, and we are looking at a session that can best be described as a tug of war. We have record highs in one corner and some serious jitters in the other. It's a mixed bag out there.
It certainly was. If you only looked at the headlines for the blue chips, you'd think the party was just getting started. But if you peeled back the layers, there was a lot of caution in the air. We are seeing a real divergence between the industrial heavyweights and the tech darlings that have been driving the bus for so long.
Let's get straight to the numbers. We saw the Dow Jones Industrial Average doing its own thing again today.
That's right. The Dow is essentially in a league of its own right now. It extended its record run, rising just over 52 points. That is a gain of 0.10%, to close at a fresh record of 50,188. That is the third consecutive intraday high. It seems that the rotation into industrial and defensive names is really holding up the index, even while other sectors wobble.
But the story was different with the S&P 500 and the Nasdaq.
Very different. The S&P 500 retreated, slipping 0.33% to close at 6,942. And the Nasdaq composite took a harder hit, declining 0.59% to finish at 23,102. We saw a distinct pullback in technology and financial stocks, which really weighed on those broader indices.
So, what is driving this split? Why is the Dow partying while the Nasdaq is nursing a headache? Two main factors: AI anxiety and the consumer wallet. First, let's talk about the consumer. We got the December retail sales data, and it was a disappointment. Sales were flat, zero growth month on month. The market was expecting a 0.4% rise. Even if you strip out autos, sales were still unchanged. That is a significant miss.
It is. It suggests that lower and middle-income consumers are hitting a wall. Inflation is persistent, and people are just tightening their belts. That naturally spooked investors holding consumer-linked stocks. But the other big story was artificial intelligence.
I thought AI was supposed to be the golden ticket.
It usually is, but today the narrative flipped to the risks of disruption. Specifically, there's a growing fear that AI tools are going to upend traditional financial advisory models. We saw wealth management stocks take a beating because of this. Plus, on the tech side, we saw profit-taking in AI infrastructure and semiconductor stocks. Investors are starting to ask tough questions about valuations and competition.
It sounds like the market is reassessing the cost of innovation. Let's hop across the Atlantic. How did Europe fare amidst all this?
Europe was mixed, mirroring that cautious tone we saw in the U.S. The FTSE 100 in London dropped 0.31% to settle at 10,354. Over in Germany, the DAX edged lower by 0.11% to 24,988.
And France?
The French CAC 40 actually managed a tiny gain, up 0.06% to close at 8,328. That is interesting because domestic unemployment there actually rose to 7.9%. So the economic data isn't great, but the market held steady.
I noticed you mentioned the UK market was down, but I heard there was some good news on the British High Street.
Yes, a bit of a paradox there. While the FTSE dipped, UK retail sales actually grew at their fastest pace since August, rising 2.3% year on year. So British consumers seem a bit more resilient than their American counterparts right now. Elsewhere, the Italian FTSE MIB was basically flat, down just a fraction to 46,803, and the Swiss market index was also flat at 13,518.
Before we move on to the currencies and commodities, we have to mention Asia. It looks like Japan is still the star of the show.
Absolutely. The Nikkei 225 surged 2.28% to a massive record of 57,651. There's a lot of post-election optimism there, and the major corporates are looking very strong. It was the clear leader in the region.
We are going to take a very short break. When we come back, we are going to dive into the Forex markets. There are some really interesting technical moves happening there, and we'll look at who the big winners and losers were on the stock market today. Stay with us. Welcome back to Market Brief After Hours. We've covered the indices, but I want to get into the currency markets. There was quite a bit of action today, particularly with the yen.
The yen was the headline grabber, for sure. USD JPY tumbled 1.01% to close at 154.30. It was a volatile session. Technically, this is significant because the pair sliced right through its 50-day simple moving average, which sits at 156.25.
That sounds like a bearish signal.
It is. It formed a bearish engulfing pattern on the daily chart. It's now testing the 100-day SMA at 154.39. If it breaks below the support at 154.05, we could see a slide toward $152. The momentum has definitely shifted to the sellers for now.
What about the euro?
The euro was much quieter. Euro USD finished at 1.1898, down just a fraction. It's consolidating gains. The key technical point here is that it's maintaining a constructive posture above its 50-day SMA, which is at 1.1742. As long as it stays above that moving average, the uptrend is intact.
And the British pound?
GBP USD retraced a bit, falling 0.35% to 1.3648. It's backing off from resistance, but the broader trend is still positive. It's well supported by an upward-sloping 200-day SMA at 1.3432. So while it's softening in the short term, the long-term chart still looks healthy.
Let's talk hard assets, gold and crypto. We saw Bitcoin taking a hit recently. Did that continue?
It did. Bitcoin extended its decline, falling nearly 3% to around $68,728. This is the third drop in 4 sessions. It's really tracking with that risk-off sentiment we saw in the tech sector. Investors are trimming exposure ahead of the inflation data coming later this week.
And gold? Is it still shining?
It's dimming slightly, mostly due to profit-taking. Gold settled at $5,031, down about 0.5%. It's consolidating after that parabolic rise we saw recently. However, the technicals are still incredibly strong. It is trading well above its 50-day SMA of $4,571. Analysts view this as a necessary cooling-off period.
Silver seems to be having a harder time, though.
Silver took a sharper hit, down nearly 3% to close at $80.97. It's facing selling pressure at psychological levels. It's still above its 50-day SMA of $77.81, but it needs to hold the $80 mark. If that floor gives way, we could see a deeper correction.
Let's wrap up with the specific market movers. We mentioned the AI fears disrupting wealth management earlier. Which stocks specifically took the hit?
It was a rough day for the brokers. Raymond James and LPL Financial both plunged over 8%. Charles Schwab was down more than 7%. The catalyst was a company called Altruist unveiling an AI-driven advisory platform. The market is terrified that this technology is going to crush margins in the traditional advisory business.
That is a massive reaction to a product announcement. But it wasn't all bad news, right? We had some earnings winners.
We did. Spotify was a standout, rallying over 17%. They reported record monthly active users in Q4, which investors loved. And in the tech space, Datadog climbed more than 15% after their revenue came in well above consensus estimates.
But on the flip side, we had Goodyear.
Yes, a blowout in the wrong direction. Goodyear fell more than 14% after their adjusted earnings per share missed expectations, and Amentum topped over 12% on a revenue shortfall. So as we said at the start, a very mixed bag. Earnings misses are being punished severely, while growth stories like Spotify are being rewarded.
It sounds like we are in a period of high sensitivity. Investors are watching every data point.
Exactly. We have Treasury yields sliding. The 10-year fell to 4.141% because markets are now betting on reduced growth and inflation. All eyes are now on Friday's Consumer Price Index report. That is going to be the next major catalyst.
We will be here to break it down when it happens. A fascinating day of sector rotation and technical moves. If you find this useful, please follow Market Brief after hours so you don't miss our analysis on Friday's big data release. Thanks for listening.